With historically low interest rates in 2020 and 2021, alongside rising prices for new and used vehicles, auto loans have become more common, even within the financial independence communities. During this lesson, we'll review an auto loan statement, and I encourage you to pull up your own recent statement if you have one. The first thing to do is ensure the debtor's name and address on file. Determine whether your vehicle is individually or jointly owned and whether it was intentionally titled upon purchase. Next, you can take note of your loan's account number and statement period, in this case, the month of July. In a moment, this period will help us to determine the anticipated minimum payoff date. The statement's account summary includes the outstanding loan balance and valuable information about the vehicle itself, including the year, make, model, and vehicle identification number, VIN, to research its current fair market value. If this information is not listed on the auto loan statement, you will find it on your auto insurance statement, which we'll cover during the property and casualty insurance lessons. Looking beyond the numbers, I encourage you to think about which vehicle features you value. For example, do you drive a car with some pick-me-up for highway driving? Or have 3 rows of seats for family road trips? A larger vehicle to haul your trailer across the country? Or a truck with a large bed for frequent home improvement projects? This is a valuable conversation to have even before you plan to buy your next vehicle. Since the pandemic in the early 2020s, driving habits have shifted. For example, I used to drive 2,000 miles per month with my Toyota Prius, and now I drive less than that per year. Is your current vehicle still appropriate for your new lifestyle? Moving down the statement to more quantitative loan information, you can view numerous details, including the year-to-date interest payments and the annual percentage rate APR, which divided by 365 days gives us the daily periodic rate. This daily rate will come in handy when requesting a loan payoff amount, which will add interest for each day that passes. The payment due date, current amount due, and any past due amounts are also included. If you've turned on auto pay, make sure you look at your statement every so often. You may be unaware if you've accidentally missed payments due to insufficient funds within a checking account, for example. Because of this loan's low interest rate, we can see below in the transaction area that nearly 90% of the payment is going toward the principal. That percentage will continue to increase as the maturity date nears, even with minimum payments. Speaking of the maturity date, although it's not included on this statement, we can transfer the loan's information to our familiar debt repayment calculator to start thinking about money in terms of time. Once the base facts are entered into the calculator, including the current outstanding balance, interest rate, minimum monthly payment, current month, and the owner's birth month, we immediately notice valuable planning opportunities. First, this loan will require a fixed annual cash flow need of around $8,600, which should be included in the budget and considered when calculating emergency fund needs, since this is a non-discretionary expense. And next, we see this loan will incur approximately $3,300 worth of total future interest if paid off minimally without additional principal payments. Dividing the future interest paid into the current outstanding balance, it's about 7%, which is pretty low due to that 2.49% rate. About a third of that total future interest will be paid over the next 12 months, with 68 months remaining. And lastly, this loan will be fully paid off when Susan is age 52, which could reduce her future expenses if she doesn't plan to finance another vehicle before then. Do you prefer to purchase replacement vehicles every few years, drive them until the wheels fall off, or sometime in between? Considering this historically low interest rate and the current risk-free yields of Treasury bonds, it may be rational to pay only minimally on this loan. But we should also consider whether this leverage opportunity will be rationally implemented or if debt is emotionally burdensome. As a likely depreciating asset and one more monthly bill to consider, paying it off early could be entirely reasonable, assuming short-term non-emergency savings is available. Also, keep in mind that a 2.49% interest rate for a 5-year auto loan is very different from a 2.49% interest rate for a 30-year fixed-rate mortgage when considering whether to pay off debt versus invest in the stock market. As shown on this chart, investors have historically been rewarded for investing over long periods of time, 11 plus years, but not necessarily when investing for only a handful of years. If you currently have outstanding debt, what are your remaining debt repayment periods? Do you hope to have no debt at some point in your life, or only certain types? How do you expect your future income to support your debt repayment strategy? These mindful questions will help you become more intentional with the right side of your balance sheet.